Hi everyone, Ben Pahl here from the Tranel Financial Group and Liberty One Investment Management. Recording this video in my basement right now, of course, as so many of us are working from home during these very unique times. So I hope everyone watching the video is staying safe and being smart right now with everything going on in our world, to say the least. Many of you who are going to watch this video know that I did a audio webinar earlier this week. We were having some video difficulties. I think the webinar software, the website itself, was experiencing just an overload of use, and it was having a hard time streaming video the way we needed it to. So we still did the recording over audio. I don't think it sounded all that great. It sounded a little muffled. So I wanted to take the time to do a very condensed version of the discussion that I had over the phone with so many of you. Wanted to take the time to film a video with a few of the main talking points. So we'll take it away. So with that said, the core message of last week's, earlier this week's phone call was just to give everyone some perspective, maybe calm the nerves a bit, maybe answer some questions relating to how everything happening out there in the economy and the stock market, all the headlines that you see, how does that really translate to you in your life and your accounts as a client of the Tranel Financial Group and of Liberty One? Now, many of you watching this video know me as a Tranel Financial Group financial advisor, and here I mentioned this Liberty One stuff to you. And many of you know that you're in Liberty One investment allocations. Just as a quick reminder, Liberty One Investment Management is a sister company to the Tranel Financial Group. So what happens in Liberty One, for your purposes as a Tranel Financial Group client, Liberty One and Tranel Financial Group are one and the same for your purposes. We have Liberty One as a separate company, as a sister company, because other financial advisors in the country utilize our investment management with their own clients, with their own practice. And just for certain reasons, we have to keep those businesses technically separate. So apologize for the confusion. I know there's another layer there, but it's an important layer for you to understand. Liberty One, Tranel Financial Group, as we do business with you as a client and the relationship we have, is one and the same. So Liberty One Investment Management is managed by the folks here at Tranel Financial Group, Libertyville, Illinois, etc. So the headlines that you see in the markets on CNBC, the economic headlines, etc. The first thing I really want to get across to everybody watching this video is, just because you see a headline with the markets, with the economy, with the Dow Jones, the S&P, whatever the case may be, just because you see that headline does not mean it translates dollar for dollar into what's happening inside your own personal accounts. This webinar is very much going to be centered on tactical growth solution and tactical income solution accounts. The vast majority of our retired clients, probably 90% of the clients that we work with who are already retired or approaching retirement, invest in one of these two allocations. So as a whole, these two allocations that we're about to talk about represent about 70% of the assets that we manage. So naturally, we should do a webinar and some communication on these specific allocations. If you're close to retirement or already retired, 90% of you own one of these allocations in your portfolio. Now, many of you own other allocations as well, but these two core allocations, either one or the other, are likely the bedrock or the foundation for your overall financial plan. So we're going to spend a lot of time just focusing in on these particular allocations. So why do I say to you that what happens dollar for dollar, what happens in the markets and the headlines, why do I say to you that what happens there does not translate dollar for dollar into your accounts? Well, as many of you know, these two allocations, tactical income and tactical growth, only zero in on 6 what we call recession-resistant sectors. And for those of you who have been my client for quite a while, you might be rolling your eyes right now saying, okay, here goes Ben again, with his 6 sectors that they're so proud of. But the 6 sectors are consumer food, consumer staples, energy, utilities, telecom, and pharmaceuticals. Because no matter what's going on in the economy, people still pay their electric bill, they still pay their cell phone bill, whatever prescription drugs they're taking, they're going to continue to take. You look at companies like Waste Management or Republic Services, it doesn't matter what's going on in the economy, garbage is still going to be collected. Clorox is still going to sell bleach and Clorox wipes. Procter & Gamble is still going to sell Kleenex brand tissue, Gillette razors, Crest toothpaste, you name it. So tactical income and tactical growth only focus in on companies in those 6 sectors. There's no airlines, there's no retail, there's no restaurants, there's very little just bricks and mortar retail. I mean, there's other than Starbucks, and Starbucks isn't going anywhere. A lot of the companies making a lot of the headlines right now, you don't own. And some of the sectors that are getting hit the hardest right now, you don't own in your allocation. I'm going to do a quick screen share here with you just to bring some of this to life in a little more of a concrete way. So here you're looking at tactical growth solution. And I know if you're a client, you've seen this before. This is nothing new to you, okay? When you see these sectors on the left side of your screen, this is what we're zeroing in on. These are the 6 sectors I mentioned, and these are the specific companies in these sectors that you own. So if you're in tactical growth solution, as you see on the screen here, tactical growth solution, yes, it's 96% equities, but it's only equities that fall into these 6 sectors. It's a 4% holding in 24 different companies. Now, I know this is nothing new to you if you're a client, but it's worth reinforcing and remembering because there's so many headlines going on right now about what's going on in the markets, and rightfully so. That's of course understandable. There should be headlines about that because everything going on right now is a very big deal. But you need to just maintain the perspective that what happens in the broad markets does not even come close to transferring dollar for dollar into what's happening in your accounts. So that's the first thing I want to get across to everybody is Liberty One, Tranel Financial Group, we go very narrow in what you own. And we do that on purpose. We don't own a lot of mutual funds, and we don't own a lot of ETFs for our clients. Because mutual funds and ETFs, they go broad. And when there's a broad market sell-off, sometimes the market shows no mercy. And if you're invested broadly, then those investments just don't show any mercy. I mean, that's just, that's how it goes when there's a broad sell-off. We saw it in 2008. We saw it in the dot-com bubble. It doesn't matter how well diversified you are in these broad holdings. When there's a broad sell-off, everything gets affected. So these, a lot of mutual funds own hundreds and sometimes thousands of different positions. And even though they might be a dividend-focused mutual fund or a dividend-focused ETF, you're still broadly owning so many holdings that when there's a broad sell-off, there's a broad downturn in those investment vehicles. So for starters, tactical growth solution and tactical income solution have experienced only about half the downside of the broad market because they are so much more defensive. So that in itself should provide you some peace of mind. You are experiencing just a fraction of what the overall market is experiencing. And tactical income solution is the exact same equity holdings as you saw on the screen, but there's a 30% bond sliver inside that allocation. Same equity holdings, but a smaller piece of each equity to make room for the bonds. Now, another thing I want to draw a really big highlighter around, just if I could circle it with a highlighter right now, it's very important for everyone on this call to understand that for those of you who are taking income from your dividend portfolio, tactical income or tactical growth. 11 companies that you own, 11 companies that you own inside of your account increased their dividend in the first quarter. 4 of them increased it in March alone. Not a single company you own lowered their dividend or eliminated their dividend. All right, 11 companies increased it. So let me share another screenshot with you. And let me transition to Liberty One's dividend update. So when I look at the dividend update here and I scroll down, you'll see here that we've got January through the end of March right here. So here's the first 3 months of the year. These are all the companies that you own that increased their dividend, what they were paying when the year started, what they increased it to, and what percentage increase that raise represents. So we went 11 for 11 in terms of companies that were expected to increase their dividend actually increased it. The only one that didn't is Keurig Dr. Pepper. Last year, some of you may know Keurig, you know, the little coffee cups, little K cups, Keurig and Dr. Pepper merged. And when they merged, they paid out a special dividend, a special one-time dividend when that happened. They are expected to announce a dividend increase later in the year. No guarantee that that'll happen. They're expected to. So their normal reporting timeline for March, it changed since the merger. So we're going to cut them some slack and just wait for later in the year for that announcement to come out. But for those that were expected to announce a raise, both allocations, tactical growth and tactical income, went 11 for 11 in terms of dividend increases. So why is this important to you as an investor? Well, if you're taking your income, if you're taking your dividends as income, you're actually going to get more income in the second quarter this year than you got in the first quarter. So here we are, markets are down over 20% year to date. Basically the worst, and I should say not the worst drop, but how quick it happened. It was the quickest bear market since the 1930s. So here we are in the middle of this coronavirus, health crisis, economic market conditions, everything that we see, and you had 11 companies that you own increase their dividend. You're taking those dividends as income. Therefore, you're going to get more income second quarter than you did first quarter. Retirement planning is all about income planning. As you hire our firm to help you with your retirement planning, the name of the game is cash flow, right? You can't retire or stay retired unless you've got enough cash flow coming in to live your life and pay your bills without working. So your pension, if you have one, your Social Security, and your dividend draws that you're getting are an important part of your lifestyle. And I'm happy to say that your lifestyle has not been affected from a cash flow standpoint when it comes to paying your bills and living your life. In fact, you got a raise. Now, does it happen like this all the time? Not necessarily. I can't make a forward-looking statement and just say this is how it's always going to be every quarter. But the quality of the companies that you own and the strength of their balance sheets and the demand for what they sell to the marketplace, whether it's garbage collection or Clorox wipes or Tylenol or razor blades or what have you, or just electric bills or cell phone bills getting paid, we feel very strongly about the long-term strength of the dividend and the fact that these dividends should be maintained, if not continue to increase. From everything we can see and everything that we're researching, we really like how these allocations are positioned. So your income component is very well intact and in fact is scheduled to continue to increase. Now you will hear headlines on CNBC about companies eliminating or reducing their dividend. But when you hear these headlines, you need to pay attention to the sectors that they're in and the companies that are making the announcements. Chances are you're not going to be invested in one of those companies. And if you are, if a company that you are invested in does make an announcement, there's no reason that we need to keep owning that company. We can always sell that company and replace it with a different one that has a more stable dividend and meets the other parameters that we feel are very important from an investment standpoint. So your income component, if you're a retiree drawing income, your lifestyle is not affected from a cash flow perspective. Now, let's say that you're 57 years old, you're 7 years away from retirement. Maybe you changed jobs a few years ago, and we manage the old 401k from that job. But you're still 7 years away from drawing income. Not retired yet, not drawing income, 7 years away. Has your account come down a touch? Yes. All accounts have. Has it gone down as much as the market? No, not even close. But you might say, well, Ben, if my account came down a bit and retirement is 7 years from now, doesn't that mean that I'm further away from my retirement goal? You know, you might like what I had to say just now about if you're drawing dividends, if you're drawing income, yeah, that makes sense. But if you're 57, for example, and you're not drawing your income, you know, doesn't that mean that you're further away now from your retirement goal? And the answer is no. You're actually closer to your retirement goal even now than you were when the year started, even with your accounts being down. And you might say, well, how the heck is that possible? Well, you own these allocations, the one like I just mentioned, tactical income or tactical growth, and you own a certain number of shares inside your account. As you reinvest dividends every quarter, right? You're not drawing your dividends out as income, you're reinvesting. As you reinvest your dividends, you're buying more shares. Those more shares get you more dividends, which allow you to buy more shares. And then those more shares get you more dividends, which allows you to buy even more shares. So what you're doing is you're accumulating shares. The more shares you have, the more income power you have. On top of the shares being reinvested and you're accumulating more, you're also getting more per share as the companies increase their dividend. I'm going to go back to my screen share here again. I'm going to show you another piece that breaks this down. So here we are. We at Liberty One, we refer to this as the double compounding effect. So the double compounding effect says the first layer of double compounding your income power is reinvesting your dividends to buy more shares. The second layer is the shares you own increasing their dividend as time goes by. So retirement planning is all about income planning. Like I just mentioned, it's all about cash flow planning. Your income power is stronger today than it was 3 months ago. It's stronger because you have more shares, because you reinvested your dividends, and you're getting more per share as the companies you own are increasing their dividend. So even though your account might be down a bit, even though it's down a bit, your income power is up. And when we build financial plans for clients, it's not about projecting the balance of the account for down the road. It's about projecting the income power of the account for down the road, for when you're ready to retire. That's really where rubber meets the road when it comes to planning for retirement. So many financial advisors, 80 or 90% of them, not exaggerating, so many of them, they'll build their models based on an account balance that's growing for the future and how that future balance can then be used to draw an income stream. Our goal as your financial advising team is to make it so the account value itself does not affect your income power. You don't want your income, you don't want your income as a client to be tied to the fluctuation of the account. You don't want the market to go down 30% and you need to be worried about the safety of your income, of your standard of living. So even though the market's down 20 and your account's down 10, just again, round numbers, even though the account's down a little, the income power is up. Whether you're saving for retirement and accumulating your income power, or you're already retired and living off your dividends, either way, the income portion of that equation is very secure. And we manage it that way on purpose by going narrow and not broad. Going narrow is the key. Okay, so we talked about how the way you're invested is insulated from what's going on in the broad market. You're not broadly invested, you're narrow. We talked about that. That should give you some peace of mind and perspective as you see everything unfold on your TV screen. We also talked about how even though the value of the accounts have come down a bit, your income power remains stable. Your income power is actually higher right now than it was when the year started. So that's great. That sounds good. But that's looking in the rear view. What are we looking at now moving forward? And what should you be thinking about now as an investor? And this will bring me to my third and final point that I want to make sure that we talk about. The investment landscape, the entire investment universe, boils down to literally three asset classes. There's cash, there's bonds, and there's equities. Everything else, whether you talk mutual funds, ETFs, variable annuity sub-accounts, you name it. There's so many ways to package these things. But at the end of the day, everything is basically packaged: cash, bonds, and stocks. Cash, fixed income, and equities. Same difference. Everything out there are just different ways of packaging those things. So what different ways, how can cash be packaged? Well, sometimes it's packaged as a savings account, a checking account, a money market, or a CD. Those are examples of ways to own and invest in cash. Cash is not going to be paying much income. Interest rates are at an all-time low. The Fed interest rate cannot go lower unless it goes negative, which is possible. Sounds weird to say, and it's hard to understand, but it is possible to have a negative interest rate from the Fed. So cash instruments are not going to be providing any yield, and therefore they're not going to be providing any appreciation. Can they be a safe haven? Can they be a protection zone for assets? Absolutely. Because you can pick up NCUA and FDIC insurance inside of a properly insured bank or credit union cash instrument. So yes, you can pick up protection, but long-term, you won't get protection. You will in the sense of true principal being protected, but the value of that principal from an inflation standpoint will go down over time, especially with all the federal spending going on right now, multi-trillion-dollar stimulus packages. The inflation erosion of cash at such low interest rates will creep up and come back to bite you a little bit in the long run. Now, is it a protection spot? Absolutely. And all of you who are clients know that I strongly encourage 6 to 12 months of just cash reserves on the sideline. I don't care how low the interest rate is, you need to have some cash reserves. Okay, I've always been an advocate of that. Those of you who are clients of mine, you know that. But cash is not where long-term money should be positioned right now. Bonds, the second asset class we'll talk about, you're not going to get appreciation in bonds. Just know, I'm not going to get into the weeds right now, but just know a basic understanding of bonds. Interest rates and bond values move in opposite directions. So as interest rates go up, bond values come down. If you own a bond paying you a 2% interest rate backed by XYZ company, and 3 years from now, that same XYZ company is now issuing bonds paying 4%, and you're the person holding the 2% bond that they just issued a few years ago, well, no one wants to buy your 2% bond. unless you drastically lower the price, because they can get 4% from the same company themselves. So in order to make your bond worth anything to the marketplace, you have to lower your price so a investor can buy at a lower price and still get the same 4% equivalent yield that you can get from the company. So you're actually going to get depreciation in fixed income. You're going to get depreciation in bonds as rates do start to rise. And before rates start to rise, you're not going to get much interest from them anyway. So cash is not going to be a good income play or a good appreciation play. Bonds are not going to be a good income play or appreciation play. You cannot look backwards at historical bonds. If you look at some bond mutual fund and you say to yourself, well, geez, that fund has a pretty good 20-year track record. That looks pretty stable. You can't look at that because for the last 20 years, the last 40 years for that matter, go back to the 1980s. For the last 30, 40 years, interest rates have been coming down, which causes bond values to go up. So bonds have been swimming with the current for the last 30 years, right? Back when mortgage rates were in the high teens, think about, you guys remember those times. You could get a CD paying 15%. Some of you took out mortgages when your 30-year fixed rate was 18%. So since that time, now interest rates are zero, literally. The Fed interest rate is zero. They've never been so low. And for 30 years, bonds have enjoyed swimming with the current. Not only were bonds paying an interest rate, but you were collecting your interest rate while the Fed was lowering rates, which makes the interest rate you got more valuable in the marketplace, which caused the value of that bond to rise. That's not going to be the case at all moving forward. It's not even possible for that to be the case because rates can't go lower unless they go negative. So bonds are not going to be a place to go. Cash is not going to be a place to go. So the only asset class left is equities. But you got to be very, very selective with your equities. And that brings me right back to where I started this presentation of going narrow. Go narrow with those sectors and specific companies in those sectors. Now, stick with me here as I'm about to wrap this up. Demand for anything, extra demand for anything, no matter what it is, whenever there's a lot of demand for something, the price of that something increases over time. It just does. That's the law of supply and demand. Dividend paying equities is going to be the only game in town for investors looking for income and appreciation. They're not going to get income from bonds or cash. They're not going to get appreciation from bonds and cash. Dividend paying equities will be the only game in town for investors that need growth and income. Are there other ways to get growth? Yes. Take a company like Amazon, right? Amazon does not pay a dividend. It does not generate any income. Is it a decent spot to capture some appreciation? Yes. Not giving advice on this video, but just bear with me for the spirit of this conversation, okay? Yes, but you're not going to get growth and income from Amazon. You could get some growth potential. So if you're looking for growth and income, you have to go to income producing equities. You have to, but you have to be selective. In this economic environment, there's going to be dozens, if not hundreds of companies reducing or eliminating their dividend. As cash comes back into the marketplace, as cash comes back into the stock markets, as we come around on the other side of this coronavirus, that cash is going to get deployed. And there's going to be demand. There will be thirst for these assets. Pension funds, endowments, individual investors, retirement plans, you name it. There's going to be nowhere else to go. They all need income producing assets. Pension funds need income producing assets. There's going to be demand for the holdings that you already own in your account with tactical income and tactical growth. So the moral of the story, did these allocations serve you well looking back here at the last quarter? Yes. But every moment in time, we as advisors and you as clients need to ask yourself, okay, that was great, but now what? Is where I am now as an investor where I need to be as we look forward? It's great in the rear view. Is it as good now looking down the road? And with the logic I just laid out there, we wholeheartedly believe that you are exactly where you should be for the foreseeable future. You're narrow, you're protected. You're insulated from what's going on in the broad market because you're not invested broadly. You're collecting a great dividend, and that dividend right now is going up. And we feel you are positioned where the demand is going to be in the foreseeable future. And that demand should cause your long run appreciation to do just fine, along with your long run income generation rising as well. Okay, so with all that said, folks, I appreciate you watching the video. You just please appreciate the spirit at which I'm coming to you here, okay? Don't interpret what I said as advice right now, because everyone watching this is in a different boat. You have to work with your personal financial advisor on any of this decision-making process, because your personal advisor knows your situation and can work with you specifically on what's right for you. As I talk about the future and just looking broadly, just take that all with the spirit intended, okay? These are not forward-looking statements. We're not forecasting. We're not promising things, but I think you know exactly where I'm coming from as I work hard here to convey some real information here to you. So consult with your advisor that you work with personally. For some of you watching this video, that advisor is me, all right? I look forward to connecting with you. I've been connecting with a lot of you. So thank you for your time. Look forward to hearing from you. Look forward to talking to you. Stay safe and take care. Bye-bye.